day, everyone. Thank you for joining us on this call today. So this is our global multi-asset end of year sort of review call, right? I can see we have some attendees from our previous call, which we had in May. So welcome back. And for those that are joining us for the first time today, we hope to see more of you on our next call. Right, so our webinar today, it forms part of a series called the Global Multi-Asset Review Call, which explores different dynamics within financial markets and the macro space, delivering expert views from both Kgori Capital and our partner PineBridge. Right, so my name is Geo-Political. I'm the Chief Investment Officer. Our first presenter for today is Jonathan. He's the portfolio manager and senior VP from multi-asset team at PineBridge Investments. So he'll take us through a global financial market update and outlook. And then he will be followed by Gito, who will give us a review of the local macro space. And then I will close off the webinar with some of our local market views, updates, and outlook. Right. So the theme for today is navigating geopolitical risks. So before we get started, some house rules. Please keep your microphone muted for the duration of the webinar. If you have any questions, please feel free to enter it on the chat box. It is on the bottom right-hand corner. So there's a chat box there. There's also, if you look at the three tiny dots, there's a Q&A option there as well. So please make use of that. And as we go along, please add your questions there and we'll take them at the end of the presentation. So with that, I'll hand over John to take us through the presentation.
Excellent. Thank you so much. And happy to be here doing this presentation for a third year running. I think it's been a great program thus far, and excited to see it continue. So in this market outlook, really what I'm looking to achieve is, let's identify the characteristics that we expect from markets moving forward in the regime ahead. How has monetary policy, fiscal policy, and geopolitical risks affected markets to this point? It's really been a seesaw battle between resilience and vulnerabilities. And how will these dynamics play out based off of the backdrop of the regime ahead? Will that seesaw battle continue? And then finally, if there's time, we'll get into how we're positioning the portfolio based off of this outlook. We're a multi-asset manager, so we're positioning the portfolio based off of specific allocations within equities, fixed income, and listed alternatives. All right, so let's move on to the next slide here, the first slide. Excellent. So it's important to understand, what the regime we're in and what the regime we're moving towards to better understand how markets will perform. And just as importantly, how various asset classes will correlate to each other in the regime ahead. So regime, it refers to a distinct set of market conditions that are characterized by economic, financial, or sometimes geopolitical factors, right? They're often defined by prevailing trends in volatility levels and investor sentiment. And in the past couple of years, we've been in more of that overheating regime, which was featuring excess demand that was exacerbated by supply chain induced bottlenecks, led to rising inflation. In short, there was a large mismatch between what consumers wanted to buy compared to what the economy was set up to produce. And in response, we saw a rapid response from central banks in terms of tightening policy and draining liquidity from markets. And as a result, both stocks and bonds ended year 2022 down. That hasn't happened since 1969, right? Over 50 years of periods where stocks and bonds traditionally had an inverse relationship in terms of correlation. But in that period of overheating, we saw that correlation spike upwards. So it's clear that we're moving towards a new regime now, and there's going to be some vast differences between what has been the norm for the past 10 to 15 years and what we can expect the norm to be moving forward. So that's what I'll spend the first few minutes speaking about. And let's head over to the next slide to see some of the characteristics of the regime ahead. And I want to break down the regime ahead in terms of features that we can expect, right? What can we expect inflation to look like? What can we expect monetary policy to look like? What can we expect market volatility to look like as a result, right? Starting with inflation, the old regime featured historically low inflation. Moving forward, we think that's going to shift to structurally higher inflation. Why is that? Well, there's more spending happening on various different themes. Decarbonization front, right? You're seeing governments and businesses alike begin to spend on decarbonization. There's also deglobalization. Deglobalization companies are moving their operations from areas of perceived geopolitical risk, right? And who's impacted by this? Well, emerging markets were the biggest beneficiaries. They were the notable winners of globalization, right? Their strength as a low-cost manufacturing hub brought new capital into their economies and helped kickstart growth in their emerging economies, right? I think one of the biggest losers in deglobalization is going to be China. China's seeing a big move away from countries who were a big move away from investments in their countries, more towards countries that are set up from an infrastructure and human capital perspective to really absorb that additional onloading of company operations. Why is that? Well, geopolitical risk is a big influence there. There's concerns about the sustainability of China's practices and the regulatory crackdowns and how they may impact businesses, right? So with the move away from China, we're seeing some beneficiaries like India and Mexico, for instance, bringing on board new company manufacturing. Why else will inflation remain high? Well, we're expecting a declining workforce as the baby boomers enter retirement age, right? What does that mean? That means more wage pressures, more competition for workers, and that's going to pass through to higher costs of both goods and services whenever you see increased wage pressures. So let's shift over to monetary policy. Central banks have been very quick to the rescue in the previous regime. Let's just stick on that previous slide, please. You know, central banks have been, very quick to the rescue when it comes to monetary policy. We think they'll be more restrictive going forward. Central banks will need to lean more heavily on monetary policy in order to get inflation under control. What does this mean? This means there's going to be a drain on market liquidity, which has really propelled markets over our historic bull run from 2011 to 2020. And then finally, gone are the days of those 10-year bull runs, right? The factors I mentioned, coupled with the fact that there's rapid development in the technological landscape, and emerging geopolitical risks, really point to shorter and more volatile market cycles moving forward, right? Geopolitical tensions, trade conflicts, and other macroeconomic uncertainties can lead to heightened market volatility as investors react to changing expectations and changing landscapes more dramatically. So in short, we expect this new regime to feature shorter and more volatile market cycles, which could be difficult to navigate for investors. So we think key to this regime will be the granularity of your investment and also identifying the beneficiaries, both from an asset class perspective and also from a security selection perspective. So there will be more benefit to being granular, and there will be more benefit to being active in this regime. Let's head over to that next slide. Tira, if you can head over to the next slide, please. I don't see it moving on my screen, but let's go ahead and I'll just start talking through, what's playing out right now and how this economic landscape is different than what we experienced in 2008 and how that will affect central bank policy moving forward. Fortunately, I don't see it on the screen. But what we'd be showing on the chart on the left is really the resilience of consumer spending. There's a line that shows what's going on with consumer balance sheets. And what we did see is a massive surge in consumer balance sheets during the COVID period. Now we're seeing that begin to rapidly come down. Consumers are spending more, and there's plenty of fuel to, there we go. That green line on the left side of the screen represents the consumer balance sheets. And what we're seeing is that huge surge upwards during COVID, and now it's beginning to rapidly decline, indicative of what consumer spending habits have been and will continue to be. There's plenty of fuel to firepower the spend in consumers, leading to market resilience. Right, the chart on the right now is showing that spending is still strong in both the private business side and government side too. As of Q2 of this year, the S&P 500 companies have ramped up CapEx spending for 9 consecutive quarters. Right, that is more specular spending themes now than there were back in the 2008. And those are some of the things that we spoke about on that previous slide. We'll call it the 3 Ds, right? Deglobalization, decarbonization, and digitalization. Big spending intentions for both companies and governments alike. What does this mean? This means central banks will have some work to do in terms of squishing the savings and investment imbalance back into balance. If everybody's spending, there's no balance in the economy. So in order to bring that to balance, central banks will need to keep rates higher for longer, making liquidity more challenging to access. Let's head over to the next slide. So I guess the natural question here is then the Fed started hiking rates in March of 2022. Why hasn't monetary policy set in? We look at how markets have performed in the first 7 months of 2023, and it's been pretty confounding, right? Central banks have been tightening policy to tame inflation, creating higher borrowing costs for companies, yet markets have been surging. And while that can be explained largely by excess savings and a strong labor market, those dynamics were largely priced in. The unexplained dynamics we've experienced this year can really be put into context by this chart here, by the fiscal thrusts enacted by the government. Governments typically begin ramping up fiscal policy to help pull a country out of recession, right? Which makes the dynamics unfolding in the first half of this year particularly surprising. For context, this has been the largest expansion of fiscal deficit outside of a recession in over 50 years. The government's been spending and been passing on tax breaks to the consumer, which have delayed and lessened the impact of monetary policy. So the way I like to think about it is they've had one foot on the gas while the other foot's been on the brake for the first 6 or 7 months of this year. Let's head over to the next slide to see where is this coming from? Where are these fiscal thrusts coming from, and why are they impacting the market the way they are? Well, it's really coming from previous authorized spending programs that were aimed to pull the economy out of the 2020 COVID crisis. These are things like that 2021 Infrastructure Investment and Jobs Act, and then the 2022 CHIPS Act and Inflation Reduction Act, right? They all kicked into high gear recently with accelerating outlays. So there's been virtually no spending in the first 2 years, and then boom, in 2023, the floodgates have opened. And this has largely been lining the pockets of businesses and helping the market remain resilient. On top of that, you had tax gains, capital tax gain breaks, which is a result from slumped asset prices in 2022. This is adding more spending fuel to the pockets of consumers and able to contribute to market resilience. Now let's head over to that next slide. And this will help explain why have markets began selling off in August then. And it's really because the surge in fiscal deficit, while it provides liquidity to markets, it also comes with a dark side. When governments begin spending, that funding needs to come from somewhere. And importantly, when governments are spending more than they're receiving in revenues, largely through taxes, it means it needs to borrow from somewhere. They're borrowing from the public. So in early August, the U.S. Treasury announced an increase to their Treasury issuances. And this started setting off alarm bells for investors, creating concerns about debt sustainability, right? Debt sustainability wasn't a top of the list concern when rates were ultra low for the last 10, 15 years. But now that borrowing costs have risen, it's becoming top of mind. And it's a concern, the ratio of debt outstanding based off of the rates that the government will be expected to pay, the interest that will be payable to the debt holders. Let's head over to the next slide, please. And we're starting to see that the fiscal deficit as a percent of GDP is beginning to soften. And once the fiscal thrusts fade, what's going to be left is the lagged impact of monetary policy. And that's what we're looking at on this slide here. The correlation between consumption growth and tightening credit conditions is very telling. As lending standards begin to tighten, as household balance sheets continue to drain, consumption will slow, economies will slow, right? So moving forward, as those fiscal thrusts, the impact begins to be, we expect tightening credit conditions really to begin to dominate. Let's head over to the next slide so we can see, another example of how this is playing out, right? This is what the lagged impact of monetary policy looks like. Consumers are contending with higher costs of goods and services on top of resumption in student loan payments, growing labor strikes, and an oil price shock as well, brought about by geopolitical risks, more supply induced than anything else. But it should be no surprise that we're beginning to see a rise in credit card balances and a rise in consumer delinquencies as well. This isn't the whole story, but it's indicative of the cracks that are forming on the economic landscape at the moment. Let's head over to the next slide and we'll see where we expect the biggest cracks to form, right? Where might the biggest cracks form as a lagged impact of monetary policy? Well, small businesses is a natural candidate, right? Small businesses who have been responsible for nearly all of the net hiring post-COVID are highly susceptible to short-term interest rates. Bigger businesses can term out their debt, they can shift things around on their balance sheets, but smaller businesses need to take out floating rate loans in order to stay alive. And they can stay alive and rely on savings for a year, maybe two, but eventually the impact of higher rates will affect profitability and it will also affect hiring. And that's when we expect markets will begin to refocus on from a Goldilocks scenario or a soft landing scenario and realize that things are a bit more challenging to land very cleanly. Right, once you start seeing that very resilient labor force unemployment number start to tick up because small businesses are no longer able to afford to continue to hire, that's when we expect markets may reconsider what's currently priced in, which seems to be more of that soft landing scenario. Next slide, please. So when will central banks begin lowering rates, right? I think that's the big question on a lot of investors' minds. And the answer, in short, is when we reach our inflation target, right? While headline inflation has been trending down for the most part, that's largely coming from transitory factors. And this is what that chart is showing, just that. Goods inflation, which was really spiking because COVID-induced supply chain pressures, peaked in the 2021, early 2022 period, those have largely come and gone. And now there's actually a risk that we're moving into overshooting territory, which can cause inflation to reverse course and begin rising again, which would create further market volatility. The next slide shows a bit of a better depiction of the disparity or the divergence between goods inflation and services inflation. Goods inflation in orange, which I have marked as transitory, right? The Fed is really fighting against the sticky services inflation, which is that green line. And that should remain sticky because of a very tight labor market and because those wage pressures will persist. As we spoke about in the regime ahead, we think that a shrinking labor force will mean more wage pressures moving forward. Right. So to recap, the savings and investment imbalance is forcing the Fed to keep rates higher for longer. Fiscal thrusts will fade, which means tightening credit conditions will begin to dominate, right? And relief isn't coming anytime soon, as inflation will remain sticky from here. So what will central banks do in response? And the following slide gives a good indication of what liquidity provided by central banks have looked like. As we spoke about at the top of the presentation, right, central banks will be slow to come to the rescue in the regime ahead. Since 2008, we've been used to seeing central banks expand their balance sheet to support markets, but the downward trend should persist from here. The continued draining of liquidity spells more cracks in the financial and economic foundation as we enter 2024. So this, on the next slide, I do want to give a recap, and then we'll head into how we're positioning the portfolio based off of the market backdrop that we just went through, right? So again, the saving and investment landscape is very different now compared to the global financial crisis days, right? Coming out of GFC, there was more saving and less spending. There was more balance, so the central banks didn't need to keep rates higher for longer to squish that imbalance. More work needs to be done currently to squish that imbalance. The recent market resilience can be explained by those surprising fiscal thrusts that we've seen in early 2023, but those fiscal thrusts come with the dark side, and that's the dark side is leading to debt sustainability concerns. From here, growth overshoots will likely lead to more rapidly tightening financial conditions, bad for markets. But growth undershoots will lead to cash flow disappointments, also bad for markets. Right? It's extremely difficult to land the plane in the middle of the economic runway. The markets have been shifting between these soft landing and hard landing scenarios all year. We believe in a third scenario, which is more of a no landing scenario where inflation remains sticky for longer, interest rates remain higher for longer, and the economy slows gradually. Markets are very expensive right now in that no landing scenario, which really speaks to our positioning and why we prefer to be underweight risk assets and be very selective and granular within the pockets of risk assets that we are investing in. So let's briefly head into the next slide and next couple of slides, which will feature some of those pockets of the market that we like to feature. So this capital market line slide, this represents the average risk return ratio of the 80 plus asset classes that we cover. A flat line means that we're not being paid to take risk, right? You can see the risk, the expected return per unit of risk that you're taking as you move further on to the right of the line. So a flatter line would mean you're not getting much incremental return on top of the risk you're taking. To put this into context, the left side of the line, you're seeing the risk-free asset, 3-month US Treasury bill earning 5% moving forward over the next 5 years. Now, moving into that middle line, you'll see that US equity is earning just 7%, but has an expected volatility around 12 to 13%. So earning an incremental 2% in expected return, but taking on a massive amount of volatility in the process really tells you that you're not being paid well for that trade-off, right? But secondly, what this line also tells us is that high levels of dispersion speak to selective opportunities for risk taking. And that's what we want to focus on here is those selective opportunities, those dots that are well above the capital market line that indicate the more you're receiving more return per unit of risk that you're taking. So the next slide will feature what our portfolio looks like at the moment. You can see just over 27% in equity, and then closer to 40% in fixed income, with some in liquid alternatives, specifically gold, and then the rest in cash and cash equivalents. The first asset class that I want to speak about here is on the next slide, which is global healthcare, right? I think broadly, we're bearish when it comes to developed market equities, but we are bullish on select pockets of developed market equities, and global healthcare is a great example of that. It's all about the trend of fundamentals moving forward, and what do we see happening in the global healthcare industry specifically is you're seeing a resurgence in terms of these discretionary procedures that have been delayed from COVID. These are the cash cows for the global healthcare industry in terms of where their revenues and cash flows are coming from. Right, so when you see more procedures coming on board, you're seeing cash flows improving. What you're also seeing is a asset class that benefits from some of the more secular themes that we spoke about. An aging population benefits healthcare. Baby boomers are moving into that senior citizenship age, which requires more healthcare spending. You're also seeing this industry expand usages through AI. They're one of the biggest early adopters of AI. Difficult to pinpoint the beneficiaries of technological investments, right? But global healthcare has been able to protect their bottom lines and adopt AI to streamline their services and make them more cost efficient, protecting that bottom line. So we think these dynamics will persist, and it's a cyclical winner, and it's also a secular winner. This is an asset class that tends to outperform in decelerating growth regimes, which is exactly what we're speaking about when we walk through our market backdrop and our outlook into 2024. The next asset class that I want to speak about, and then I'll pause so that we can have time for the next sections and we can touch more in the Q&A. But Japanese banks, we're talking about some idiosyncratic selective opportunities that really should benefit from the specific backdrops that they're found in. And Japan banks is a great example of that. What's going on in Japan with their central bank policy? Well, they're in the process of moving from a very long period deflationary regime period into an inflationary regime period. So yield curve control, which was a central bank policy that gave the country the ability to control both the short end part of the curve and the 10-year part of the curve, that was really enacted to help fight against disinflationary forces and deflationary forces. With deflation turning into inflation, it gives central bank policymakers in Japan reason to do away with yield curve control. So there'll be no more constraints on that longer term interest rate. So what does that mean? That means longer term interest rates will expect to rise in Japan from this point forward. And who are the biggest beneficiaries of rising interest rates generally? Well, it tends to be banks. You see banks tend to outperform because the spread that they're receiving on borrowing costs compared to savings, what they're paying out for savings, creates a larger difference, right? And you begin to see that pass through to profits. So we think Japanese banks is a prime beneficiary of rates moving off of 3-decade lows, moving towards higher in the regime ahead, specifically in Japan. So let me pause here. We can speak more on positioning if there's any questions in the Q&A. I do want to pass it over to our colleagues from Kgori to go through the local market update.
Okay, thank you, Jonathan. I'll be taking us through the local macro outlook and really what we've seen so far in the year. Section, please. We will be starting off with GDP growth. For the second quarter of 2023, GDP growth came in at 5.0%, more than the 5.5% that was recorded in Q1. The main driver for growth during Q2 2023 has been the mining sector, which grew by 7.3%, up from 5.0% in Q1 2022, and the non-mining private sector growth, which actually slowed down to 4.3%, down from 6.0% in the previous quarter. We still hold the opinion that growth for the year 2023 will be between 3.8% and 4% for the year. And this graph on the right there shows that all sectors of the economy experienced positive growth during the second quarter of 2023. The strongest performing sectors being the mining sector, with year-on-year growth of 7.3%, wholesale and retail with 5.3%, and transport and storage with 5.3% as well. Now, a very surprising feature of the results that came out of the second quarter of 2023 is the strong performance of the mining sector. Even though we've seen some stock problems or difficulties that have been faced in the diamond market. And that is something that we will elaborate further on in a few slides. Next section. So the second area that we like to look at is inflation. The inflation imprint for October 2023 came in at 3.1%. We forecast inflation to rise to about 4.2%, 4.1% in November. And this is despite the fuel price increase and then subsequent decrease that took place during the month of November. Our forecast is that inflation, this current rising cycle that inflation is experiencing, will probably peak around February 2024, quite close to the 6% upper bound that has been set by the Bank of Botswana. But inflation for the year should peak in August, also quite close to that 6% upper bound that the Bank of Botswana has set. Previously, we were quite confident that we would go beyond that 6% upper bound, but the likelihood of that happening has now reduced significantly, given the changes in the movements that we've been seeing in international oil prices, and also the sort of softer growth that we're starting to expect for America, given the leading business cycle indicators and what they are telling us. Moving on to the next slide. Next section, please. In line with the question that we're facing as to why has the mining sector been so resilient, even though we've heard about all these problems within the diamond market. Well, some of these problems and some of this resilience that has been there has begun to show cracks. The first slide on the left shows the sales value of De Beers site sales. The ninth cycle, which is the most recent cycle, had sales valued at $80 million. This was down 82.4% as compared to cycle 9 in 2022. And looking at a more sort of longer term time span, the sales for Q3 were down 45.0% this year as compared to the last year's Q3, and sales in Q2 were down 26.3%. Now, this effect has been experienced by the local market. If you look at the diamond trading sector, which is the downstream activity that is associated with the diamond market in Botswana, we've seen its growth significantly slow down from year-on-year growth of 24.6% during the first quarter of the year, down to 2.8% during the second quarter of the year. So we're already seeing that the softer diamond market has already affected sort of downstream activity and output within Botswana. On the production side, since the start of the year, De Beers have been cutting, or Anglo American has been cutting production in the first quarter. Q1 production will cut production by 0.1% compared to the previous year. Second quarter, they cut it by 4.5% as compared to the previous year. But what we will notice is that the Botswana production, that hadn't been reducing. So during the first quarter of the year, the production was actually up 11.6% year-on-year, and in the second quarter, it was up 5.6% year-on-year. All this is going to change within the third quarter of the year, because that is when the Botswana production also began taking a significant hit, or a significant reduction, reducing by 12.2% year-on-year in Q3. So we will see this feeding off into GDP figures, and we will see mining sector slow down from that high of 7.3% for the year down to more the late 2%, early 3% year-on-year growth for Q3 2023, which will lead to a slower economic growth for Q3. Next section, please. Another very interesting sector to look at when we're discussing geopolitical risks and geopolitical tensions is the banking sector. As geopolitical tensions rise and risks increase, we will find that financial restrictions between countries become more common. You start seeing increased uncertainty, and then they'll also start facing significant chances of cross-border outflows. And this effect, as Jonathan had mentioned, tends to be greater for emerging markets such as Botswana. Our banking sector has continued to perform well, and the reason is why is that? Well, the answer can be found within our commercial banking sector and their assets and how it's spread out. So net loans and advances, which is a domestic base, account for about 58.8% of our banking assets, whilst balances that are due from foreign banks only account for about 14.5% of total banking or commercial banking assets. So this has provided local banks with a certain amount of resilience when it comes to increased cross-border funding expenses, and that has helped our commercial banks to keep that cost of funding down. And another thing to note is that for Botswana, local factors will play a much bigger role than international factors. One good example of that, if you look at the graph on the right, is that there was a bond maturity in June 2023. And as a result of that bond maturity, the commercial bank holdings that are in the BOB's, the central bank's standing deposit facility, which is where commercial banks park their excess liquidity so they could gain some form of interest. That was up 202% following that maturity of the bond. And this led to, again, excess liquidity, or there being more liquidity, and banks now having the ability to reduce their FD rates. So we can see that since, I guess, May 2023 to August 2023, the highest sort of like fixed deposit rates that banks have on offer dropped by about 100 basis points. Next section, please. This graph on the left is just a way just to illustrate how much excess liquidity has improved over this sort of short period. Excess liquidity as a proportion of total assets went up to 6.3% in August of 2023, which is the highest level it has been since about 2021. And as a result of this, the spread between the asset yield and the cost of deposits for banks has increased to about 8.7% which is a record high level. So as a result of this, we can continue to expect that strong performance from banks that have led to record profits within the sector. Next section, please. Another critical juncture to look at when it comes to the local economy is credit uptake, and we have witnessed a slowdown in credit uptake during the course of the year. Year-on-year credit growth stood at 10.3% in August 2023, down from 10.7% in January. Household credit uptake that slowed down to 10.3% from 11.2% at the start of the year, and private businesses credit uptake also slowed down to 4.6%, down from 10.1% at the start of the year. And the reason why the drop in total credit household total credit uptake has been rather muted at 0.4% during the year is because of borrowing by government and parastatals, which is year-on-year uptake grew from 9.2% in January to 99.9% in August of 2023. And it's just a reflection of the high interest rate environment that we are currently experiencing as Botswana. Next slide. Next section. Just to wrap up, we will be giving our outlook on monetary policy and how we view rates changing. So our first sort of bear case would be a 50 basis point increase in interest rates during the first half of 2024. We've assigned this a probability of 5%, which is quite low, but because by international standards, Botswana's interest rates are actually low, we can never say that there's no chance of interest rates being raised. When we move to our base case, which we have at about 65%, this is where we see a 50 basis point cut in monetary policy taking place during the fourth quarter of 2024. This is just simply when our inflation outlook has inflation trending sustainably between the 3 to 6% target or objective range that has been set by the Bank of Botswana. And our bullish case would see a 25% basis point cut taking place during the first half of 2024. And this would mainly be driven by the current trend that we're seeing of reducing oil prices and these sort of leading business cycle indicators suggesting a slowdown in growth in the US market and slower sort of global growth. And so we have that, we increase the probability of that to about 30%. Thank you. I'll now hand over to Tim.
Thanks, Kitso and John. I think there are a number of overarching themes that have flowed through from John's presentation to Kitso's. I mean, the structurally higher inflation that we will trend into, higher than the previous that we knew, that slower growth that is expected across the board, really, and also that liquidity sort of drawdown that we're seeing. But just speaking to now our financial markets and how those sort of themes are going to be coming in. Next section, please. Just starting off with the local equity. So we have seen over the last sort of 2-3 years, we've seen quite a rally within local equities. And this has been driven by one, obviously higher earnings expectations as a whole, but also a return of liquidity into the market, because before then, especially between 2015 to 16 up to your 2020 time, there had been multiple structural challenges that we had seen within the market. So now we've seen that unwinding and more liquidity coming in, so in terms of more demand, but also when we move to the next section, please, you'll see that even though there's been this rally in asset prices or local equity prices, we've also seen earnings coming in very strong, especially on the recovery trade post-COVID. So even before that, the market had been cheap, but structurally assets were not coming into the asset class. But now we've seen that even though assets are coming in, earnings are still, outperforming. And as a result, so despite that price momentum, we've seen that on a historical basis, the local equity market is still cheap relative to its historics. We also noted that a lot of selectivity has to come into play now, because we've seen the rally being driven really by your financial sector, especially very select names. But we've seen that in this year, we've seen now the the property sector starting to look attractive. We've seen now the hospitality sector also starting to look attractive. So there's that sort of pivot now within the local market. So even rallying quite significantly, there are still pockets of value that remain to be taken advantage of. Next slide, please. So this next section just shows, in terms of our expectations of earnings, we still expect that the broad market will do very well, but like I said, it will be driven by sort of a different, because we've seen that uptake from the banks. We expect that they'll sustain it, but however, the real driver of growth this next phase, we expect to be other sectors that have lagged the recovery in the last few years. All right. So just this talking to how we've positioned, or we are positioning the portfolio. So historically, we've been really underweight on the hospitality and on property because we saw headwinds. But now we're seeing that unwinding, and we will be unwinding these positions and taking up more of a position within these sectors where there is value as well, because certain counters are traded in terms of the valuation much more richer than others. So where it makes sense, but also where there's quality at a reasonable price to ensure that there is still upside once we've moved in there. So just looking at, again, the outlook for local equities, we think that the market is still undervalued, but we are being very selective as to how we start participating within the sector. There is quite a push in terms of infrastructure spending from the government side. So obviously trying to position to ensure that we capture some of that growth from there. Moving on to the fixed income side, I just wanted to illustrate how we've seen a number of issuances, or the doubling of government's issuances. And as a result of that, from 15 billion to 30, as a result of that, if you look at on the left-hand side, this is what the government curve vis-a-vis corporate curve looks like. And then on your right-hand side, you see what it looked like in 2017. So in 2017, we saw the government curve was very, very low, right? And with your longer end at around yielding around 5.4%, right? We've seen that come up quite significantly. The longer end is now yielding around your 8.5% levels. So we've seen quite more or less a 300 bips movement throughout the curve over the last few years. And this has really happened 2021, 2022. That was when we saw most of the movements within the government curve. But if you look at where the corporates are, you'll see that they haven't moved as significantly as where the government has moved. Plus, the issuances are not as much as they were 5 years ago, 6 years ago. So I think there is more scope within the fixed income space, but it also shows how spreads, so the difference between the interest rate the government is paying on their bonds vis-a-vis the interest rate a corporate is paying on their corporate bonds, that difference has come closer and closer. It used to be much more. So we're seeing now that there's more value with government issuances because you're not being compensated with more yield for taking on more corporate risk, right? So that reward is no longer there. And we've seen this on Friday, we had government bond issuance, and we've seen that curve come down because there's more demand for those securities. Again, from a risk return perspective, at the current pricing, they make more sense, right? So going forward, we're seeing liquidity now channeling more towards government issuances, specifically because of where the curve is. And that's starting to, one, drain liquidity, and two, your corporates are now not, fulfilling or issuing to where they'd expect. So we're seeing issuances that are not fully subscribed on the corporate end because the value just isn't there. So that is a theme that we're seeing. That is somewhere we are also participating in it, because we haven't held government bonds for a very long time, but we are starting to look into it because of these sort of dynamics. So from an absolute return perspective, but also from a relative perspective, your government bonds are starting to offer far more value than the corporates have been, right? So I think just moving on to the next section, it just shows again the curve and how it hasn't moved much in terms of the government curve over the last 4 quarters, but the big movements, we've already gone past them, but we will see that it'll now move lower because of this past auction, right? So that's positive for bond prices, and we should see the bond portfolio starting to do very well, right? And then just to move to the outlook slide, again, we don't expect to see any sort of rate moves up. What is purely driving our credit markets right now is liquidity dynamics and sort of yield. So we're seeing more move towards fixed instruments versus floaters, and simply because market wants to lock in all of those rates and take on duration. And that is how we are also positioning the portfolio. So I think at this juncture, we have reached the end of our presentation, and we're happy to take any questions that you might have. Just Q&A. Okay, I think we have 2 questions. Let me see global oil prices. I think perhaps, John, if you'd like to start us off.
Sure. I see 3 questions in my Q&A, so I'm just going to read off the first one, which came in at about 20 minutes ago, and that's, are there specific industries or sectors that are more advanced in incorporating geopolitical considerations into their strategies? Difficult question, right? I think there's a recent survey that was actually released by Oxford Economics that showed businesses perceive geopolitical tensions to be the biggest threat to the global economy and to their business moving forward. This is a survey of bigger businesses. And the reason it's such a big threat is because it can be extremely unpredictable. You don't necessarily know how governments will act. You don't know how tensions will develop and what the outcome will be. But more of a rule of thumb, I think you can expect the 2 biggest industries, the 2 most vulnerable industries, to be tourism and energy, right? You start to see an impact of supply chains, which can be very difficult to predict, and that usually has the most impact on supply chains as it pertains to oil development. All right, the sectors that I think are most resilient to geopolitical risks are things like digital transformation and climate transition. Right, these are very secular, defensible spends that every country is going through currently, both governments and businesses alike. So less impacted by the dynamics that are going on between inter-country relationships, and more about making sure that your business and your country is on track to get where they need to get to from a digitalization and a decarbonization standpoint, right? If you look at specific industries like cybersecurity, for instance, maybe that's one that's benefiting from the rise of political tensions, right? More companies and governments are getting smarter about the way they're protecting their data, and their spends in themes like cybersecurity have been on the rise since 2019 and continue to rise from there. So that's a theme that we're invested in inside of our portfolio in a sub-asset class we call the productivity basket, which is focused on productivity enhancing software that's based off of the spend prioritization of the decision makers that are making the calls on where they spend IT budget. Right. And I guess another way to answer this question is, which asset classes also benefit most from the geopolitical risks? I would say, gold is the natural one, another asset class that we're invested in. Gold is emerging as, a preferred choice in the current economic landscape because it's a traditional safety asset, which benefits from prevailing risks that we're seeing and also has capital efficiency as a hedging instrument, right? So heightened geopolitical disruptions will probably further boost gold prices from where they are currently. I do see that there's another question. Can you provide examples of vulnerabilities in global production networks that have been exposed due to heightened geopolitical risks? Is AI at risk? I think this is actually pretty similar to the previous question in that, there are a lot of global production risks that stem from geopolitical risks, and oil is the biggest one that I highlighted, right? And I think what we're seeing in 2023 is the new OPEC alliance, which is now comprising of China, Russia, and Saudi Arabia, has really engineered an oil supply shortfall through the first 3 rounds of production cuts that were announced earlier this year. And you're seeing oil prices skyrocket as a result of that. So I think when you talk about where are the biggest risks in terms of global production, that's where I would say. Outside of that, we did speak about the trend of either nearshoring or reshoring, right? A lot of countries are rethinking their investments in regions that they perceive as having heightened geopolitical risk and heightened levels of uncertainty about how policy will impact their businesses moving forward. And China is a great example of that. And who's that production shifting to? It's those countries like India, those countries like Mexico that are set up both from an infrastructure standpoint. They have the building and the digital infrastructure in place to be able to absorb the elevated amount of production needed from their regions, but they also have low costs of labor there as well. So those would be the biggest beneficiaries from a shift in global production or a shift in supply chains. And the second part of the question, as it pertains to AI, I mean, the rule of thumb is, as geopolitical risks rise, innovation tends to fall, right? That's just the natural consequence. And this past month, the US has announced a ban on the sale of advanced AI chips to China. So for a more granular example of how geopolitical risks are playing out into relationships, but also into specific industries. So the expectation moving forward is that technological advancements will be more uneven as a result. There's less sharing of knowledge. There's less joint regulation. So you tend to see an unevenness in technological advancements coming as a result. Right now, I think everyone's struggling to understand how AI can be adopted to increase productivity in business and increase profitability in business. But over the next few months, I think, or maybe next couple of years or so, that should become more and more clear, and we should see the consequence of geopolitical risks on AI as a result.
Okay. Thanks, John. I think the next round of questions are more local asset focused. So I'll take the sort of, there are 2 questions. The moderating of the portfolio on diversified financial services, why is that? And then on the amendment of the Pension Fund Act and how it'll impact fixed income yields. And then I think, Tito, if you could come in with the outlook for recovery on the mining sector. Okay. So just talking to our positioning on diversified financial services, I think this group has done very well. There is still some room to run. We feel that there is some value still on the table. However, going forward, we are also looking at where the next round of opportunities also lie. I think it is always prudent, and it's the way that we think in terms of our philosophy, to, before the market reacts, to say, okay, where do we see the next pocket of value? Where can we how do we enhance portfolio value? Not saying that we will reduce our allocation, but with time it will be it will be diluted, as you were. Not that we're exiting, but it'll be diluted as we increase holdings in other areas where we see more opportunity for growth, right? Should we not sort of see anything where within the quality specifications that we have, then we will maintain our holdings. However, we are always on the lookout for where the next round of value will come from, right? And then on the Pension Fund Act, so I think it is also important to understand that, yes, there's this liquidity expectation that is coming back. However, first and foremost, where are our current allocations? Because so the NBFIRA sort of annual report it provides numbers that are a little bit dated, right? So on where we are as an industry currently. So you'll find that if anecdotally, if we look at the Forbes Asset Manager Watch, for instance, you'll see that there is quite a bigger tilt towards, it is more than that 30% that we have sitting locally. So when you look at the next two sort of rungs of expectations this December, you will find that we might not see the big moves that we expected, simply because a number of portfolios are already in line, right? Especially on the larger side of things. So that's the first port of call. The second port of call is we're seeing, obviously, the issuance and the interest from on the government debt side, right? So yields are coming lower. It is natural that will happen, both on the fixed deposit side and on the bond side. I think that there is a sweet spot. Unfortunately, with our economy, we export a lot of our liquidity, especially we're looking at infrastructure spend. That's really, really happening right now. We don't produce much in terms of steel rebar or cement products, etc. Yes, we've increased our production of these materials. However, the inputs that we require for our outlay of infrastructure is mostly imported. So we export quite a significant amount of the liquidity that we have in the market. So we expect that we will start to see that coming to the fore. We've seen a number of issuances, not a lot, but a number of issuances that are not hitting their targets. So there is need for that liquidity. The question is, since it's really channeling a lot more on the government side, what's going to happen to corporate spreads in the near term? Because that liquidity is now, there's a competition for it. So somebody has to pay up, right? I think I'll stop there and hand over to Kito to take the recovery outlook for the mining sector.
Okay, thank you very much. So the diamond market, which is where the largest part of our mining sector is concentrated towards, is highly correlated with growth in the US, given that they are the largest source of consumer demand for diamonds. And the outlook is that US growth should moderate in the year 2024 down to close to about 1%. Or thereabouts. And as these leading indicators as we've discussed, these leading indicators for the US economy are showing the real possibility of a slowdown within the US economy. We do not see consumer demand for diamonds improving much in the next year. Another sort of big player is China. And so there is scope for them to offset the sort of moderation in US growth but also Chinese recovery has been faltering. There's been a lot of policy chat that the Chinese government would be taking measures to support domestic growth in China. But there's not much belief that these will have the impact that is expected due to Chinese growth. So in terms of the consumer demand side of things, we do not expect to see that improving significantly over the course of the year. And because of the production, Anglo American did not cut their production for the year. That's still, I think, between 30 and 93 million. Next year, there should be a significant slowdown or a significant reduction in the production outlook, simply because of all the stockpiling that they have been doing now, and the expenses of that would start catching up to Anglo and De Beers. So we should see a slowdown or a reduction in total mining production in 2024. Whereas the other sectors, copper, that has been performing quite strongly. We can expect a greater output in terms of the copper mining in 2024. As more players join the local game. I think that should cover our outlook for the mining sector. So we're not very optimistic on it, more especially because of the consumer demand in the US and China.
Thank you very much. I think we've sort of reached the end of our call for today in terms of the time that we had allotted. Thank you very much for taking the time to join us for today's webinar, and thank you for the engagement. We hope that it'll not end here. If there are any further webinar.
Thank you.
Thank you, everybody.
Thank you.